This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Tumultuous week. Stocks close out the week on a calmer note, but the wild swings remain with investors. The question is, what have we learned? Finding value. Following this recent turbulence, our monitor has some winners in sectors that may have been left for dead. And crisis and recovery. A look at how New Orleans is faring 10 years after Hurricane Katrina. All that and more on this Friday, August 28th. Good evening, everyone, and welcome. I'm Sue Herrera. Tyler Matheson is off tonight. Taking a breath. That's what investors seem to do following a week of breathlessness on Wall Street. After several point losses and severe point losses on Monday and Tuesday, then big gains on Wednesday and Thursday, stocks were pretty calm throughout today's session. By the close, the Dow lost 11 points to 16,643. The Nasdaq climbed 15, and the S&P 500 added more than a point. For the week, believe it or not, the Dow and the S&P 500 rose about 1%. The Nasdaq gained more than 2.5%. But with that gain, the Nasdaq recovered a nearly 9% plunge from earlier in the week, its biggest intra-week reversal ever. And that is just the tip of the iceberg when looking back at what a wild week on Wall Street it really was.
There is the opening bell. But guys, the Dow's down 1,000 points.
There was real, genuine panic selling like I haven't seen in years.
These are enormous moves, things that were making my eyes pop out of my head when I was watching some of the quotes here.
As of this moment, it is the strongest rally of the year.
We're in sort of a very strange, uncharted territory right now.
A volatile final hour of trading, turning this rally into a decline.
Trading was chaotic, the Dow cratering into the close.
We're now heading back up.
Well, the market's rebounding today, but it has been a wild week of volatility.
So those people who were waiting and hoping that they would take advantage of a meltdown found the clock was running out.
Markets just don't go up forever.
We have another roller coaster session on Wall Street.
Have we bottomed here, and are we working things out to the upside?
You have to go all the way back to Black Monday 1987 to get this type of volatility in the market.
If you think the stock market has seen some wild swings this week, check out what is happening to oil. Crude soaring again today.
Here's how we're finishing the day. The Dow only giving up 14 points into the close. The S&P and the Nasdaq today did turn positive there at the end of the session. A wild week on Wall Street.
But it's Friday, finally. Brian Jacobson joins us now to discuss what we've learned after this tumultuous week on Wall Street. He is Chief Portfolio Strategist at Wells Fargo Advantage Funds. Nice to see you, Brian. Welcome back.
Thanks, Sue. Thanks for having me back.
Let's start with basically that question. What have we learned through this whole week?
Well, I think that there's really two big lessons from this. Number one is that investing entails taking on risks. And sadly, we've been sort of lulled into a sense of complacency over the last few years without a lot of volatility in the markets since the last correction, if you define that as a peak to trough of about 10% in the S&P 500. We haven't seen that in quite a long time. So this is a reminder, those types of things do happen. However, I think the second lesson is also that sometimes the best thing to do in a crisis is to really do nothing. What we saw on Tuesday was actually sort of nationwide redemptions from mutual funds, exchange traded funds and the such. And that was just as the market was beginning to go back up. So sometimes people react, and reacting is sometimes a negative thing to do to your portfolio.
So what do you do now? Is this an opportunity, perhaps, a gut check in a way?
Yes, it did feel like a gut check. It really did, because sometimes those reminders come out of the blue and they are painful. I think that this is a good opportunity for investors to sort of look at their portfolio and think about where do they want to be positioned for the longer term. And when I talk about longer term, it's not about where do you want to be over the next, say, 10 days. It's where do you want to be over the next 3 years. And for that, I think that there's still some tremendous opportunities in foreign markets for U.S.-based investors to take advantage of at these slightly lower levels.
What markets do you like in particular outside of the United States?
Yeah, two of my favorite areas. I like Europe. I think that Europe is returning to growth. Some of the economic data, the fundamentals there appear to be improving. And the valuations based on, say, price to earnings and the such are much more attractive there than they are in the United States. Another area is the emerging markets. Now, emerging markets have been in a bear market that's more than 20% down from their peaks back in September. But there, if you're discriminating about where you invest, I think that you can actually find some very good long-term opportunities.
What does oil tell you? I mean, we've seen a huge move in oil. Everybody thought that oil was going much further to the downside. Now we've had this key reversal in the oil market, meaning that we've almost made a V-shaped bottom in oil. What is that telling you about the economy?
Yeah, I'm not sure what to read from oil as far as with the economy. I think that what it tells us is with this V-shaped move, it was more like a short squeeze in a way where suddenly everybody's piling into shorting it and then it bounces and everybody gets squeezed out of it. Because I actually think oil is heading back towards about $60 per barrel. The big move down was probably triggered by fears about slightly slower growth than what a lot of people anticipated. Also, we didn't see a lot of supply response until really this week. We heard suddenly about firms deciding to cut back on their exploration activities. So if you have a little bit less supply in the future, a little bit more demand, that should push prices higher.
We briefly were in correction territory for all three of the major indices this week. Does that satisfy those traders and investors out there who have been looking for a 10% correction in this market to keep the bull market healthier in the long run?
Honestly, I hope it does, because I actually don't think that the correction was justified on the basis of the fundamentals. It was probably based upon people just overreacting to slightly mildly negative information coming out of China. So hopefully this is almost like cathartic, where it gets it out of people's system to remind them that in bull markets even, you can have these corrections. But the key thing is to focus more on that longer term. And I think that we probably have at least about 2 more years left to this bull market.
All right. On that note, Brian, thank you. Enjoy the well-deserved weekend.
Thank you.
Brian Jacobson with Wells Fargo Advantage Funds. Well, one of the concerns hanging over this market, as you know, has been the timing of a possible interest rate hike by the Federal Reserve. Some rumblings out of the Fed gathering in Wyoming is suggesting that those that think a September hike is off the table might need to think again. Steve Leisman has the inside word from Jackson Hole.
A top Federal Reserve official speaking beneath the sunlit Teton Mountains in Jackson Hole today shed a little light on whether the Fed will hike in September. Fed Vice Chairman Stanley Fischer said a September rate hike, which would be the first in 9 years, is still on the table. Fischer said it depends on the economic data and the markets in the next 2 weeks, but he was clear about which way the rate needle is pointing.
We're heading in that direction. What's happening in particular with the labor markets, and we'll have to see if that continues when we get the data for next week, has been impressive, and the economy is returning to normal. We're not certain we're there yet.
Fischer's comments come after a wild 10 days on Wall Street that began with the Chinese devaluation and saw huge daily 100-point market swings. Many connected them to the chance of a Fed hike.
We've got time to wait and see the incoming data and see what is going on now in the economy.
Fischer tried to ease market concerns over the rate hike, saying the Fed could indeed stop for a while once they do a single hike. But not all Fed officials are convinced. One of the most dovish members of the Federal Open Market Committee, Minneapolis Fed President Narayana Kocherlakota, cautioned that the market is sending a message the Fed should listen to.
The market volatility actually does matter. It's not so much as a cause, but as a signal. I think it is a signal of uncertainties at the global level about global demand, in particular going forward. I view those as representing a tail risk.
That puts extra pressure on next week's jobs report. A strong payroll number and calm financial markets could well light the way to the first Fed rate hike. For Nightly Business Report, I'm Steve Leisman in Jackson Hole, Wyoming.
Well, the Fed says it is data dependent, and today we got some more data. And it was a batch of mixed reports on the health of the consumer, the backbone of the U.S. economy. The Commerce Department found that Americans made more and spent more in July. Income rose 0.4%. Spending wasn't far behind. But consumer confidence declined to a 3-month low in August, missing expectations. As we mentioned, not only was it crazy this week for stocks, there were huge moves in oil prices. Domestic crude had its biggest two-day percentage gain since 2009, as traders were betting on lower prices and then had to cover those bets. Prices were up 6% today to $45.22 a barrel. For the week, prices rose nearly 12%, crude's first weekly gain in some 2 months. While everyone is on edge because of all of this volatility, we're looking for market signals in unexpected places. This year's Great American Trucking Show may not seem like the typical venue for investment advice, but America's biggest transports are an important economic gauge. Morgan Brennan is in Dallas with the lowdown on big rigs.
Each year, hundreds of truck owners descend upon Dallas with their tricked-out, meticulously decorated big rigs to face off in the largest truck beauty pageant in the country.
Today I'm here vying for a national championship in the Pride and Polish division.
While these drivers are competing for cash prizes and bragging rights, fleet executives are sounding off on the economy. Nearly 3/4 of all freight tonnage in the U.S. is moved at some point by a truck. Swift Transportation President and COO Richard Stocking says based on how much his trucks are hauling right now, he expects consumer spending to pick up in a meaningful way headed into the holiday season.
If you look at history, it's been a bellwether. Before we go into recessions and we come out of recessions, we typically see it beforehand. And I think it tells us that we don't have to jump off a cliff, that things are steady, they're strong, and we think we'll have a vibrant fourth quarter.
And Swift isn't alone. Covenant Transportation, which specializes in moving expedited freight for retailers and e-tailers, also anticipates a very busy peak season.
We are expecting a lot of great things in the second half. The expedited e-commerce is a niche that we do extremely well and extremely a lot of business in e-commerce, and every one of our customers are anticipating a very good fourth quarter.
According to Avondale partners Donald Broughton, over the past 40 years, trucking tonnage has predicted every single recession and recovery. Right now, it's indicating a steady strengthening of the economy. But the trucking industry is facing its own headwinds, most notably a steep driver shortage. The American Trucking Association estimates as many as 40,000 workers are needed right now. To recruit and retain drivers, companies are hiking pay, adding benefits, and letting some help design their own trucks. Werner Enterprises is also aggressively targeting women, who make up a mere 5% of the industry.
We're now approaching 10% of our fleet being female drivers. Their accident rates are better, their pull-in rates, their inspection rates are better. They've just done a really good job. We found that they're very diligent, very detail-oriented.
Another big focus for trucking right now, automation. With Daimler and Mack trucks marketing vehicles outfitted with smart technology such as cameras and radar systems that read lane markings and issue warnings if another vehicle gets too close. All of which begs the question, when will trucks be driving themselves? While Daimler unveiled an autonomous vehicle earlier this year, the consensus here is that due to regulations and the insurance industry, big rigs like this won't be fully self-driving anytime soon. For Nightly Business Report, I'm Morgan Brennan in Dallas.
China may have been a horror show for investors this week, but Tinseltown is still betting big that working with that country will be a Hollywood ending. We'll tell you why next. Twitter unveiling an ambitious diversity initiative. By 2016, the social media company hopes to increase the number of underrepresented minorities on its staff substantially. Last year, the firm reported that 70% of its employees are men and the majority of its staff are white. The company says it wants its makeup to reflect the range of people that actually use its service. Concerns over the Chinese stock market and that country's growth prospects may have spooked investors, but it isn't scaring Hollywood studios, which are still bullish and are continuing to bet big on the potential for the Chinese box office. Julia Borston takes a look.
The Chinese box office is booming, up more than 60% so far this year over the same period last year, after growing more than 30% per year for the past decade, according to Rentrack. It's on track to surpass the U.S. box office by 2017. Warner Brothers is now in talks to create a joint venture to co-produce local language movies in China and distribute them there.
The fastest route to gaining access to the Chinese market or even expanding the access one studio or another has is by partnering with people in China.
Warner Brothers would be joining Disney, 21st Century Fox, and DreamWorks Animation, all of whom are similarly partnering to co-produce and distribute films with Chinese companies. Hollywood's Chinese language productions in the works are in addition to the boost they're getting from a growing appetite for their English language films in China. This year, Universal's Jurassic World had the biggest global opening weekend in history, thanks in large part to its $99 million opening gross in China. Marvel's Avengers: Age of Ultron was Disney's biggest ever release in the country. And analysts are bullish that those Chinese box office dollars will keep on flowing to Hollywood, regardless of the country's stock market and currency fluctuations.
I think that a change in currency valuation doesn't really affect any individuals in China who want to go to the theater. They're going to continue to pay that U.S. equivalent of $2, $3, or $4 for a movie ticket, and that's still an attractive value proposition for their entertainment dollar.
The downside, Hollywood studios bring home just about a quarter of their Chinese box office gross as a result of government restrictions. That's about half the percent that studios get from theaters here in the U.S. But it's still a positive for Hollywood studios. It's money they didn't earn before Chinese moviegoers got hooked. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Mylan gets the go-ahead on its proposed takeover of Perrigo, and that's where we begin tonight's market focus. Mylan shareholders overwhelmingly approved the drug maker's bid for Perrigo, and this allows the firm to launch a tender offer for the company's shares in the next few weeks. Perrigo has rejected the deal and said it doesn't think its own shareholders will sell shares to the firm. Mylan was off 2% to $50.37. Perrigo also slipped. It slipped 1.5% to $185.42. Shares of United Continental and Activision Blizzard rose in today's session. The airline and the video game maker were added to the S&P 500 index. The firms will replace Paul Corp and Hospira on September 2nd after the market closes. United Continental popped 7% to $57.12. Activision Blizzard was more than 4.5% higher. It finished at $29.22. Dow Components, Apple, and Boeing are reportedly teaming up with the Department of Defense. The firms will be creating wearable technology for the U.S. Armed Forces. Apple was up a fraction to $113.29. Boeing was up 1% to $133.24. GameStop beat Wall Street's earnings and revenue estimates. The video game seller issued guidance that disappointed some investors, so shares tumbled 8%, making it the worst performer in the S&P 500 today, closing at 42.49. And Big Lots also reported results that topped consensus. The firm hiked its full-year forecast as improvements in its merchandise mix helped results. The shares climbed more than 15% to 48.58. And now to our market monitor, who likes deep value stocks. He says investors should be buying at these lower levels. The last time he was on in December, he recommended ExxonMobil, which is down 20% because of the drop in oil prices. Europe hedged equity down just 1%, and Memorial Production Partners is off more than 50%. Greg Abella is the portfolio manager at Investment Partners Asset Management. Nice to see you. Welcome back again. First of all, tell me what you see in this week's action. What does it tell you about the market?
The market's trying to digest a number of different data points. Data out of China that doesn't seem to sync up with a country that's growing at 7% GDP. Currency devaluations that are trying to sync up to try to get exports in line for a lot of developing countries.
So just a lot of noise out there from the market. All right, deep value stocks. For those who don't know, what basically are they?
They're companies that tend to trade at discounts to their book value or trade at deep discounts to their earnings. And they're companies that may be in a turnaround phase.
Okay. Let's take a look at your picks. We mentioned Memorial Production Partners, which you had last time, so you still are recommending that stock. Why?
Well, the price target from analysts is still roughly about the same level as the last time I was on. It trades in line with oil, but it's one of the most rigorously hedged master limited partnerships in the space and pays a really nice cash distribution, currently at 17% at this level.
And the price target is $13.31. Government Properties Real Estate Investment Trust, GOV is the symbol.
If you're an investor who wants the government to pay you, this is a good place to start. It's a real estate investment trust that owns government office buildings, pays a 10% dividend yield. The government tends to pay its rent on time.
And are they long-term tenants?
They tend to
be very long-term. Is the U.S. government a long-termer?
They tend to be very long-term tenants, and the buildings are green buildings, so it's not easy for the government to move out of one building and into another.
Does a change in interest rates affect a real estate investment trust the same way it might affect another real estate type property?
That or any fixed income investment, and I think that's already been discounted in the price, which is why it's down so much. But at about 7 or 8 times earnings, it's cheap.
7 or 8, yeah.
Plus that yield.
Micron, that stock has been really hit very, very hard.
Very hard, and trading at these cheap levels, it's attracting value investors like myself, and it also has Union Group from China, who's apparently trying to make a takeover bid for $23 billion. I don't know if it'll be successful, but at this valuation, it's cheap enough, I think, that it's attracting a lot of interest.
So it would be a deep value stock, but you also could play it for the potential of takeover.
You could. Also, you could play for the potential of growth. They've just developed with Intel a microchip that's a NAND chip that is 1,000 times faster and has 10 times the storage of other NAND competitors. So,
how long do you usually hold a position in any of these deep value stocks? Long term or short term?
Usually, and particularly the ones that are paying income. And if you believe oil prices, in the case of Memorial, ultimately will be way higher, it's something that you hold for the very long term and get paid while you wait.
Now, you mentioned the Memorial production. With oil prices being so volatile this week, does that make a difference in the way you look at the stock? Because now we're up above 45 again.
I think some of that is some short covering from people that were expecting the price to go way into the 30s, and it didn't happen.
So it's not a fundamental for this particular stock?
It trades in line with oil, so you have to take that into account. But ultimately, I think that oil will probably end the year at somewhere around 60, and then further in the future will be substantially higher.
Okay. Greg, thank you. Have a great weekend.
Thanks for having me.
Nice to have you here. Greg Abella with Investment Partners Asset Management. Hurricane Katrina brought devastation to New Orleans nearly 10 years ago to the day. It may be a decade, but the city is still on the road to recovery. We will take you there next. Here is what to watch next week. More Fed speak. We'll hear from 2 Fed presidents. Lots of data, including the ISM Manufacturing Index, auto sales, and international trade. And Friday is Jobs Day. We'll get the employment report from August. And that is what to watch next week. Residents and insurers in South Florida are prepping for the possible arrival of Tropical Storm Erica. The governor has already declared a state of emergency. The storm is forecast to reach the area sometime on Monday. Hurricane Katrina made landfall in Louisiana 10 years ago tomorrow. It remains the costliest natural disaster in U.S. history. So what happens when a major U.S. city has a near-death experience? And now we have a much better idea, a decade after that storm nearly wiped out New Orleans. Scott Cohn covered that disaster in 2005. He is back in New Orleans to report on a decade of ups and downs.
The floodwaters are long gone.
As long as this levee remains open and broken like this, the water is going to continue to flow.
But destruction is still here. The population in the lower 9th Ward, a fraction of what it was.
This is the question by which the recovery of New Orleans must be judged. And until there are more than 34% people back here, the recovery of New Orleans is not complete.
Other parts of the city are doing much better. The city's more middle-class Lakeview section is buzzing with construction. At the Data Center, a nonprofit group established well before the storm, researchers have been working to make sense of it all.
Folks who are doing okay or well before a disaster do better. They benefit from the infrastructure investments and various improvements, whereas folks who were either poor or had bad health before the disaster really struggle to rebound.
While poverty is twice the national average, New Orleans' overall economy is strong, thanks in part to $140 billion in government spending since the storm.
We have one of the fastest growing economies in the nation, #1 in population growth, #2 in per capita GDP growth. We're first in export growth.
Also crucial, support from companies that could just as easily have given up on New Orleans. Zurich Insurance says it's given $13 million in contributions.
We're very confident that the result of acting, what we think is correctly and in the most socially responsible way comes back to us in multiple dividends over time.
Big corporations like Entergy, like Shell, like Chevron doubled down on their commitment to the city, to the region. And I think in large part as a result of that, New Orleans today is much more vibrant than it's been since the late 60s.
That kind of commitment is more important than ever now as the memories and the money from Hurricane Katrina begin to fade, leaving New Orleans to move forward on its own 2 feet. Scott Cohn, Nightly Business Report, New Orleans.
And finally tonight, say goodbye to the Goodyear blimp. The iconic airships that you've surely seen floating over sporting events are being retired. They'll be replaced by a new airship, and you probably won't be able to tell much of a difference. The new airships, which aren't technically blimps, are quieter and faster, making them easier to maneuver for the camera crews that are always on board. And that will do it for Nightly Business Report for tonight. I'm Sue Herrera. Thanks so much for joining us this week. Have a great weekend, everybody. We'll see you again on Monday.